All right, here we are again. Let's get right into it. I hope you did your homework as always. I know this the last class period I assigned exercise 3-2, I believe, wasn't it? And this was on adjusting journal entries. Now we're kind of in that place where we're talking a lot about adjusting journal entries and then chapter 4, closing journal entries. One thing I want to make sure you guys on the test, which is coming up, make sure your brain is shifted into the right mode. Every now and then, I'll ask on the test, to do some closing journal entries, but people are shifted into the adjusting journal entries mode. Okay, so you got to read close. Am I asking for adjusting journal entries or closing journal entries? Okay, the homework we're going to go over right now is exercise 3-2, and it is on adjusting journal entries. All right, so let's take a look at that. Does it seem like we've just done a lot of AJEs? Okay. Well, we have, because that's the best way to learn how to do them. Okay. So exercise 3-2. I'm going to put all the answers up. Maybe you won't be able to see them all at the same time. But I'm going to put all the answers up, and then we'll kind of talk about them. Okay? Yeah, I might be able to get them all up there. Okay. Okay, this is exercise 3-2. And just leave it on the answers if you would while I just talk. For each of the cases, they want us to prepare AJEs for the year ended December 31, 2011. Okay? Now, in A, 1/3 of the work related to $30,000 cash received in advance is performed this period. Okay? So we initially booked that $30,000 as unearned revenue, but we've earned 1/3 of it. 1/3 of 30,000 is 10,000. We can move it out of unearned revenue and into fee revenue, or revenue, right? Okay. B, wages of $9,000 are earned by workers but not paid as of the end of the year. Well, we debit wage expense, we credit wages payable. All right. C, depreciation on the company's equipment for 2011 is $19,127. We know how to do a depreciation entry, don't we? Depreciation expense is debited, accumulated depreciation is credited. D, the office supplies account had a $480 debit balance on December 31, 2010. During 2011, $53.49 of office supplies are purchased. A physical count of supplies at year end shows 587 of supplies available. Now they actually did a little T account down here and put in the beginning balances, the purchases, the ending balance, and we have to figure out how much was used up. Well, the amount used up was $52.42, wasn't it? So we debit office supplies expense, and we credit office supplies. Okay? E, the prepaid insurance account had a $5,000 balance on December 31, 2010. An analysis of insurance policies shows that $2,200 of unexpired insurance benefits remain at the end of the year. So how much was used up? $2,800, right? $2,800. So we debit insurance expense and credit prepaid insurance. F, the company has earned, but not recorded, $750 of interest from investments in CDs for the year ended December 31, 2011. The interest revenue will be received on January 10, 2012. So this is interest revenue we're dealing with, right? So we have to show that at the end of the year, we are due $750. We book that as an interest receivable, and we book that as interest revenue. Make sure you don't just put interest. Put interest receivable and interest revenue, right? Because on G, we have some interest expense on a loan, bank loan, right? How much do we owe as of the end of the year? $3,500. So we have to book that expense in the proper year and show it as a payable. at the end of the year. Does that make sense? Okay, any questions on that? Okay, one thing I want to point out real quick, and I don't know if anybody was confused on this, but I want to clarify. Do you remember when I did the REAL thing? Remember that when I did that? And I said every AJE will affect a revenue or an expense and an asset or a liability. Do you remember when I did that? Okay. I wanted to make sure. One student thought I was saying we always debit one of these and we always credit one of these. Did anybody understand it as that? Okay, that's not true. Okay? It's just saying that in every journal entry, a revenue or an expense will be affected, and an asset or a liability will be affected. Cool? And then, of course, I think the other thing that helps, as I always say, in every AJE, it's either an expense being debited and something else being credited, or a revenue being credited and something else being debited. It's one of those two. Correct? Okay, any questions on exercise 3.2? You guys should be pretty adept at doing these by now. But if you are not, or if you want some extra practice on AJEs, or if you want some good study tools for the test, I want to show you something. Okay? So let's go over to the screen. I'm going to log into Angel. Of course, you folks at home have this same situation here. So let me log in. Oh, for Pete's sakes. Okay. Okay, then of course you select your class, whatever semesters you are in and whatever class that you are in. Okay, and you get to a screen like this. Go to Lessons. Go to Handouts. Go to Chapter 3. And look what I have here. I have 3 extra AJE handouts for extra practice. You don't have to do those. We're not going to go over them in class. But if you want extra practice on AJEs, here's not only 1, not 2, but 3 handouts you can do individually. And then here's the answers to those handouts. Okay? So that's another 25, 26 or so AJEs in total you can do with your friends and family. Okay? But we're not going to go over them in class. You don't have to do them. They're there if you want them. Okay? If you're at the point now where you do those AJEs and you look at the answers and you still don't understand it, then we probably need to get together or something. Okay? All right, so that is there. Cool? Okay. Questions on that? I'm officially closing the chapter on Chapter 3. All right? Now what I want to do is go to Chapter 4. Let's just review a little bit on what we talked about last period. We talked about how we're doing closing entries. Okay? There are some accounts that we close. We reset them to 0 balances at the end of the period, so they're all ready to use for the next period. Okay? Now we talked about how not all accounts are closed, are they? There are temporary accounts and there are permanent accounts. And one of the questions I guarantee you will be on the test is I'll list accounts and you have to tell me if it's a temporary account or a permanent account. Okay? What are our permanent accounts? Those are the accounts that we don't close. Our permanent accounts are assets, liabilities, and owner's capital. We do not close those at the end of the period, right? Okay? On the test, I can always tell those who don't know what they're doing because they close everything. Okay? We do not close assets, liabilities, or owner's capital because they are permanent accounts. What do we close? We close our temporary accounts. Our revenue accounts are temporary. Our expense accounts are temporary. Our withdrawals accounts are temporary. And we learned about this new account called income summary. That's also temporary. And we close those, don't we? We talked about the 4 steps of the closing process. The first thing we do is we close all the revenue accounts. The next thing we do is we close all the expense accounts, and we close both of those to income summary. All right? Then we do our T account for income summary, and we figure out our balance, and we close that to owner's capital. And then our fourth and final closing entry is we close withdrawals, not to income summary, but to owner's capital. They gave us an example in the slides. Okay, they showed us an adjusted trial balance, and then they wanted us to close this. Well, the first thing we did is we closed the revenue accounts. Now, of course, revenue accounts have credit balances, thus we have to debit them to close them, correct? Then we closed the expense accounts. Expense accounts have normal debit balance accounts, so we had to credit them, right? And we debited income summary, all right? Then you have to do a little T account. They may not show that, but that's how they got that 3785, is they made a T account for income summary, and they credited the amount of revenues, and they debited the amount of expenses. There was a balance of 3785 to the credit, and we have to debit that to close that, right? And we close that to capital. Then we close our withdrawals. Now, withdrawals is a debit balance account, thus to close it, we have to credit it, and we debit capital. Okay? Make sense? Now, let's go ahead and take a look at exercise 4.2, which was what I assigned you for homework. And I assigned it with different instructions, didn't I? Okay, so I hope you wrote that down. One student emailed me and forgot I gave them specific instructions, and they were like, I don't know how to do this. Well, it's because what they're asking you to do in the textbook itself, I haven't even taught you yet. So what I wanted you to do is on exercise 4.2, for this adjusted trial balance down here, I simply wanted you to post your closing entries in regards to that information. Okay? So, let's do that. Okay, the first closing entry we had was to close marketing fees earned. That's the only revenue account on there, right? I hope you didn't make the mistake and close unearned fees, because that's not a revenue account, is it? What is that? It's a liability, okay? So going back to the screen, we closed marketing fees earned, and we credited income summary, correct? We had to debit marketing fees earned because it's a normal credit balance. Our next closing entry was we had to close our expense accounts. Now, we close those all in one journal entry, okay? We don't close each expense out, by itself. A couple of things here. Make sure you don't just put total expenses, $62,200. Because this is not a little financial statement. This is a journal entry. You see the debit and the credit column here. These are journal entries, and they're commanding us to go to marketing fees and debit it for $79,000, to go to income summary and credit it for $79,000, and so on. Okay, so these are JEs. I don't want to see lines here in total or whatever. Okay? The other thing is, the biggest mistake that students make is they're so used to crediting revenues and debiting expenses that they flip-flop these journal entries. Do you see what I'm saying? No, you debit your revenues, you credit your expenses. It seems odd, but that's what you do. Now, this is the point where you want to do a T account. Okay? This is the point where you want to do a T account. Okay, so I have a T account for income summary. We credited it for $79,000, and then we debited it for $62,200. 200, right? Now, what is the balance of that account? What's the balance of that account? Anybody?
16,800.
It's 16,800 to the credit, isn't it? So that is the balance we're dealing with in income summary right now, right? So if we want to close that, and we do, what do we have to do? What do we have to do if I want this to have a zero balance? We have to debit it for 16,800. Now it's going to have a zero balance. So what I do is the third closing entry is to debit income summary for 16,800 and credit capital for 16,800. Okay? Does that make sense? But the number for that third closing entry is totally derived from the T account that we did. Here's a mistake some people will make. Did anybody accidentally put in the number 64,500 in here? Okay, a few people. Where'd you get that? You got off at the trial balance, right? Okay, if you looked at the trial balance, the adjusted trial balance, the amount of capital was a credit balance of 64,500. We're not closing capital. Capital is a permanent account. We're not closing capital. So don't take that amount of 64,500 and put it in here. We're closing income summary to capital. Capital's not being closed. We're closing income summary to capital. Look at the screen again. Do you see how this is sort of a flushing of the effects of the period into the capital account? You see what I'm saying? We're zeroing out the revenues and expenses, and we're flushing the effects into this capital account. Make sense? All right. And then the fourth closing entry is we close withdrawals. We close withdrawals. Withdrawals has a debit balance of 14,400. And so we have to credit it for 14,400. Does that make sense? Okay, now we had a net income situation in this example, didn't we? Because the revenues were greater than the expenses. So this should make sense that we are crediting capital. Capital is a credit balance account, and we are increasing capital. And that should make sense because we have a net income. And we know from our statement of equity that when you have a net income, that's one of the things that increases capital, right? It should also make sense that when we close withdrawals, capital is being debited or decreased. Because we know from our statement of equity that's one of the things that decreases capital. Correct? You with me? All right, any questions on that? Now, what I want to do is go back over to your PowerPoints, and we're going to talk about the next step in the closing process. This isn't a journal entry, but this is what we do next. We're going to prepare what we call a post-closing trial balance. And this is a list of their permanent accounts and their balances after post-closing entries. So what we do... Oh, is that somebody's phone ringing? Is that somebody's phone ringing? That, I don't know about you folks at home, but our rule here is if your phone rings in class, what do you have to do? You have to bring cookies for the whole class. So, thank you. All right. Okay, look back at the screen again. This is a list of the permanent accounts and their balances after posting closing entries. Okay? Now let's look at an example of the post-closing trial balance for fast forward, and this is the example that the slides had. This is a post-closing trial balance. Now if you look at this, all you should see are permanent accounts, correct? You see some assets here. You see some liabilities, and you see the capital account, right? Do you see revenues and expenses? No, why? Because there's a zero, right? Okay, those are zero. Now, the post-closing trial balance, do you think something like this might be helpful to in preparing financial statements? No. Why? What's the first financial statement we prepare? The income statement. You're going to have a real hard time preparing an income statement with just this information, aren't you? Okay, because remember, we prepare the financial statements after the adjusted trial balance is completed. The only purpose of a post-closing trial balance is for you to look at it and make sure that there's no temporary accounts that have balances that you forgot to close. Cool? Now, one thing I want to point out is if I go back, see that capital balance of 33,585? See that right there? That was the beginning balance of capital from the adjusted trial balance, but it has the third and the fourth closing entries posted to that. Okay? You understand what I'm saying? Let me go back. If you go back to the original adjusted trial balance up here, you can see that capital has a count of 30,000 at the balance, right? Now that is not the number that's on the post-closing trial balance, because we have to take that $30,000 beginning balance and we have to go to the third closing entry. We have to credit that $30,000 for 3785. You can imagine a T account. And then on the fourth closing entry, we have a debit to capital for $200. That's how we get this balance of 33,585. If you don't do that, if you don't post that third and fourth closing entry, that capital balance is going to give you an amount that's going to result in these debits and credits not being equal. And we need those debits and credits, the total of debits and credits on that post-closing trial balance, to be equal. Does that make sense? So that is a post-closing trial balance. So now what I want you to do is for exercise 4.2 that we just did, I want you to prepare a post-closing trial balance. Okay? You folks at home, I want you to as well. Shouldn't take too long, but let's do that. Prepare a post-closing trial balance for exercise 4.2, which were the closing entries we just did. Use those closing entries. Use the information in the textbook to assist you in doing a post-closing trial balance. So let's do that at home. Let's do that here. Let's let the music roll, and we'll get back together here in a few minutes. Okay, we are back. So let's take a look at that. The post-closing trial balance should look like, if I can get my papers straight. Let me enlarge that a little bit. There's what it should look like. No, you have a column. Like all trial balances, if it has an ending debit balance, it's in the debit column. If it has a credit balance, it's in the credit column.
Well, I know, but I mean, like the franchise, you can't like switch over franchise.
Oh, you know, again, the order should somewhat be cash, liabilities, capital. But if you had these in different positions, but the same amounts in the same columns, you're okay. Okay. But because that's a contra asset and an asset. And you might have even wondered, what is franchise, right? That's an intangible asset. I wish they wouldn't have thrown that one in there, but that's an intangible asset. Do your total debits equal your total credits? Did anybody accidentally try putting in their capital amount of $64,500 to begin with? Some people might say, where'd you come up with that? I put in $64,500 and didn't balance. Well, remember, if we do a, let me see, make sure I have the right one. If we do a T account for capital, what was the beginning balance of capital before we did our closing entries? What was it? It was $64,500. And then our third closing entry credited capital for $16,800. And our fourth closing entry debited it for $14,400. What's the ending balance of that?
Yeah, we can't
What is it,
see
66.9? Huh?
We can't see the capital.
Thank you. Okay, let me do that again. Can't see the paper, Krug. Okay, our beginning balance of capital was $64,500 from the books, right? Our third closing entry, we credited capital for $16,800. Our fourth closing entry, we debited capital for $14,400. Now, what's the ending balance of capital now?
$66,900.
$66,900. And that is the amount. That is the amount that goes right there, correct? Otherwise, the total debits don't equal the total credits. Kara.
So pretty much the first one that we did, which was the closing entry, created our capital. Is that correct?
What we did is the first thing that you do, the order is you post your 4 closing entries.
Right.
And that flushes the effects of the period into the capital count.
Okay.
Then once we've done that, then we prepare the post-closing trial balance.
Okay.
And the post-closing trial balance is after we posted everything to the accounts, right? Because otherwise, our revenue, if we have to post our revenue and expense amounts from the closing entries too, right? Or else they wouldn't have zero balances. Okay? So yes, you're right. Does that answer your question? Mm-hmm. Okay, cool. Other questions? I really appreciate when you guys ask questions because most times these are the same questions people at home have. All right? Okay. Any questions? All right. We're starting to get to the end of it, aren't we? Chapter 4 was pretty quick, wasn't it? Well, we're not completely done. But closing entries are usually a lot easier than adjusting journal entries. Did you find that? Not yet?
No.
Maybe you will. Okay. I'll give you some more homework on closing entries. Okie doke. All right. I want to talk about a few more things that you're going to find in Chapter 4 to kind of clean things up. Now, I want you to make sure that you read, write this down, folks. I want you to read in your book pages 147 through 151. I know, 5 whole pages or whatever, right? I want you to read pages 147 through 151. Okay? And that's going to be on the classified balance sheet as well as the current ratio, which is the ratio at the end of this chapter. That's a very important ratio. Okay? Now, the classified balance sheet. Now, before we were doing when we were doing balance sheets before, we just kind of threw them all. Kind of threw everything together. The classified balance sheet divides things up into different categories, and one of the main categories that they divided up is they divide things up in regards to if it is current or non-current. Okay, you have your assets. Some of those assets are current assets, and some of those assets are what we call non-current assets. You have your liabilities. Some of your liabilities are what we call current liabilities, and some are what we call non-current liabilities. Now, the differentiation between current and non-current is at the bottom of this slide, and I'm going to simplify it a little bit for you at this point in your career. Current items are those expected to come due, both collected and owed within, let's just simplify this, within 1 year. Okay? Now, what I'm crossing out is not hardly ever the case. Okay? And at this point in your accounting career, I'd just soon you just not even worry about it. Okay? So, current items are those expected to come due, both collected and owed, within 1 year. Okay? Said a different way, current assets are those that are expected to kind of be used up within the next year. Okay? Current liabilities are what you owe within the next year. Does that make sense? And non-current or long-term assets, and non-current or long-term liabilities are assets that are not going to be used up within the next year, and liabilities that are not due within the next year. Does that make sense? And again, I want you to read pages 147 through 151. But what we end up doing then is a classified balance sheet, and this is an example of one. Now, what I did here, this is actually just the first half, because you just have assets up there, right? But do you see how I did a separate section in blue for my current assets? Now, I want you to memorize what are your current assets and what are your current liabilities. Your current assets, because this is important and you'll see it a lot in your business education. Your current assets are cash, short-term investments, accounts receivable, merchandise inventory, all your prepaid expenses. Another thing that would be a current asset that you might write a note there is supplies. This company doesn't have any supplies, but supplies are also a current asset. But those are assets expected to be used up within the next year. Okay? And we do a subtotal for current assets. You can see that. Total current assets, 42,900. We want to know this number here. That's important. And and as we learn about the current ratio, you'll see why. So we do these different subclassifications. The first one is for current assets. Then we also do a subclassification on a classified balance sheet for long-term investments. And we do one for plant assets as well. All right? And then they have one here for intangible assets. We'll learn more about those in Chapter 10. But do you see how a classified balance sheet just has different subtotals and it kind of categorizes things more? It's not real hard. It just kind of categorizes things. The main thing you have to know is what are your current assets. Look at all the items in black. Those are items that are not current assets. Okay? Long-term investments, fixed assets, plant assets, stuff like that. Sarah?
Is this like a debit credit column?
No, and I'm glad you asked that.
Okay.
Look back at that. There's actually 3 columns, isn't there?
Yeah. I understand the totals, but I didn't know why the assets were on the credit side. But
yeah, please. Yeah, I'm glad you asked that. This is not. You have to always be careful because in some things like trial balances, like the post-closing trial balance and the adjusted trial balance, there's a debit column, there's a debit column, and then there's a credit column. But in some things like this, they're just grouping things together.
Okay.
And there's three, looking back at this, there's three columns up there, so there couldn't be a debit credit, right? Because there'd be something else too, right? So there's no magic about the columns that they put these in. And you know what? If you all prepare a classified balance sheet, which you will do tonight for homework, it's going to look a little different. Everybody's going to look a little different. That's okay. But financial statements, there's no debit or credit columns. Okay? All right, let's take a look at the different sections. Again, current assets are expected to be collected or sold within a year. The long-term investments, those are expected to be held for more than 1 year. You have your plant assets or your fixed assets. Those are things like land, buildings, automobiles, equipment. And then you have your intangible assets. Don't worry about those for now. We'll learn about those in Chapter 10. Now, the other side of this balance sheet is the liabilities section. Just a second there, Kara. The liabilities section. And here we want to differentiate between current liabilities. Those are the liabilities due within the next year. Examples of current liabilities are accounts payable, wages payable, salaries payable. This note payable, we really need a little bit more information there. I'll probably would say, let's just say that's a note payable due in 6 months. And then there's something called a current portion of a long-term liability. Okay? Now, let's say here that what they have here is, let's go to the Elmo. They have a liability, and the liability is for $157,500 in total. Okay? It's for $157,500 in total. Now, they've gone through their analysis, and they figured out that $7,500 of that is due within the next year, and $150,000 of that is due not within the next year, but beyond that. So what they did is they stripped away that portion that's due within the next year, and they put it in this current portion of long-term liabilities. You see that? And then the rest of the liability, the long-term portion, net of the current portion, is shown there in long-term liabilities for $150,000. So that is a complete, those two slides are a complete balance sheet that's classified. All right. And again, I want you to read pages 147 through 151. Kara, did you have a question?
Yeah, on the slide where you first showed everything.
Yeah?
Why, is there a reason that they separate both depreciations? It says store equipment and then less accumulated depreciation, and then buildings, less accumulated
okay, good question. She's wondering why they have two accumulated depreciations here, why they separated that. That just must be how the company does it. And again, different companies do things different ways. I usually see accumulated depreciation as just one account under all the fixed assets.
Yeah.
But that's just the particular way that this company did it.
Okay, so we can combine them?
Yeah.
Okay.
Good question. Other questions? Okay, now you see how on a classified balance sheet how we did this subtotal for current assets, and then we did this subtotal on the next page for current liabilities. Okay, that takes us into what is next, and that is the current ratio. Now, every chapter does a ratio, and some of them are more important than others, but this is one that is important, and I guarantee you'll be tested on this. There is something called the current ratio. What does the current ratio measure? Well, the current ratio, first of all, is figured out by taking your current assets divided by your current liabilities. Okay? Your current assets divided by your current liabilities. Now, you know, we did subtotals for those on the classified balance sheet, didn't we? Okay? So this should be pretty easy to compute. Now, I always want you to know on these ratios what they measure. Do you see, looking at this ratio, that it measures the company's ability to pay its debts in the near future? All else being equal, would you want this ratio to be high or low? High. Wouldn't you want your current assets to be greater than your current liabilities? What if you had current liabilities of $20,000 and your current assets were only $5,000? That'd be a current ratio of 0.25. Yee, that's not very good, is it? You've got $20,000 worth of debt coming up in the next year, and you only have $25,000 of current assets. That's not good, is it?
And you only have 5,000. You said 25.
Okay, thank you. Let me say that again. In my previous example, I said, what if you had current liabilities of $20,000 and assets of only $5,000? Current assets of $5,000, current liabilities of $20,000, that would give you a 0.25 current ratio. That's not very good, is it? How are you going to pay those current debts, right? As a rule of thumb, you'd like your current ratio to be at least 2.0. It's kind of a rule of thumb. It can vary depending on industry. Okay? This is one of the ratios when I go do consulting. I figure out their current ratio for each month, and I trend it over time. And I see if their current ratio is declining or staying the same or getting better. When I see a current ratio that's just gradually going down, what I can say is you guys are getting very close to having troubles with liquidity. You're going to have troubles paying your bills. Okay? Very important ratio. Now look at this ratio again. I once had a true-false question, and it was this. True or false? The current ratio helps measure a company's profitability. Is that true or false? That's false, but doesn't just sound so good. This doesn't have anything to do with profitability, does it? Do you have any idea what their net income is in looking at this ratio? No, there's not only no net income in this denominator or numerator, there's no revenues or expenses. The current ratio does not measure a company's profitability. It measures the company's ability to pay its debts in the near future. Okay? So sorry I messed up on those numbers there a minute ago. But read about that on page 150. I want you to know the current ratio, though. Okay? I want you to know how to compute that because it may be the most common ratio that businesses utilize. Okay? It's one that banks always want to know. They want to trend it over time. Okay? Cool? All right. Okay, let me give you your homework, and then we shall let you go. Okay? Any questions while I'm writing this down? Now, we will spend, we only have one more lecture after this one, and then there's the test. Okay? So it's coming up, isn't it? For you folks at home, always look at your emails or your syllabi to know when your test due dates are. But for you folks, we have the next lecture and then the test. You with me? Okay. So for homework, again, so we're going to spend most of the time next period just going over homework. Okay? I mean, the last lecture before the test, I don't like to lecture over new stuff or you're not going to have any time to do homework. Okay? So you have a little bit more homework than normal. But some of them are real quick and dirty. Okay? All right. Let's take a look at this. Here's your homework I want you to do as the room gasps. Oh my goodness. You know, teachers who don't love you would not give you as much homework, but I care about you guys, okay? Now, these three right here, I know in those you're going to be preparing financial statements. I want to make sure you remembered how to do that. I think exercise 4.5 is actually doing a classified balance sheet, okay? But read each one carefully. There's no special instructions on those. But I want you to do those for next time. I don't think it's going to take you as long as you fear. But the whole next period, we will just pretty much be going over homework, We'll be talking about the test a little bit and all that, okay? All right, so remember those practice AJE handouts are out there on Angel, as well as the answers if you need more help or if you want to utilize those as you start to study for the test. Okay? See you guys.